Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be looking at how to invest our first $100 using Robinhood. So I've been kind of putting together a list of stocks that we're going to be taking a look at here, and dang it, there we go, back to it. So we're going to be taking a look at AbbVie Inc., Abbott Laboratories, Colgate, and Footlocker. So each of these are paying, their ex-dividend date is next week, and we're going to be taking a look at that. And I'm going to be choosing one of these that we can buy with our $100. So we're going to go ahead and start with AbbVie. So AbbVie is a pharmaceutical company that discovers, develops, and markets both pharmaceuticals and small modular drugs. It originated in 2013 as a spin-off of Abbott Laboratories. So taking a look at AbbVie, it has a nice dividend ratio of 3.57. Now I generally like to have an average of 4% dividend yield in my dividend stocks. So depending on some of the other ones that I'm going to be adding in my portfolio, that will balance itself out nicely. It's not too low that it'll counterbalance any higher dividend stocks, and it's not too, it's not too high either that it's going to be good for long term. So we can see that their PE ratio is 18. So in a market right now that has a pretty inflated PE ratio, their price per earnings is relatively low. Today they went down 1%. So tomorrow they're going to be you can see right here they continue to drop off, but they kind of recovered after hours. They're going to be a nice discounted price compared to where they were a month ago. Actually, they're still up from where they were a month ago, 4.33%. They are a really nice company long term. Since 2013, they've grown 117%. So they are a spinoff of one of the companies that we're going to be taking a look at here. I'm going to go ahead and switch over to dividends.com. So again, they have a 3.55% dividend yield, so very close to what Yahoo is displaying here. The only reason this one is showing a 3.57 is because based off the current market today, it went down 1.03%. So the dividend yield went up, but if we purchase the stock tomorrow, we'll lock in at that low or that higher dividend yield for that stock. Okay, so back over here to dividends.com, we can see that AbbVie has been paying dividend growth for 44 years. Now, AbbVie is a spinoff. It says right here it's a spinoff of Abbott Laboratories. So that's why the dividend growth is showing 44 years, because Abbott, which we're going to be taking a look at here, has been paying dividends for 44 years. We can see that their next ex-dividend date is on July 12th, which is next week on Wednesday. So if we purchase it on Friday, July 7th, we would make the mark-off date for the ex-dividend, and we would get paid on the 15th of August. So these are some of the things that I was looking at. So each of the stocks that we're looking at today are stocks that are having their ex-dividend next week. So I'm going to be purchasing one of these stocks, and I am going to be getting I'm going to be owning the share during the ex-dividend date, and then I will be receiving the ex-dividend or the dividend pay. So we can see that their payout ratio is 46%. So it is below the I think anything below 60% is fine. It's in the pharmaceutical drug manufacturer area, so their payout ratio is really nicely. They have been paying dividends for 44 years. If we go down, we can see that their dividend. Let's see here. Okay. So we won't have to increase the time here, but we can see that their payout period, they have been increasing it. So in 2015, they actually increased it during 2015. Looks like prior into 2013 into 2015, it had stayed around a consistent. Oh no, it went up there a little bit. Their first year it was at 0.4, then they went to 0.42, they increased it 0.49, 0.51 mid-year, and then have continued to increase it. So they are offering a growing dividend. Oh yeah, it shows right here. So very easy dividend history. So ABVV is one pick that I'm looking at. Next is Abbott. Now this is their parent company that currently has 74,000 employees, operates in more than 150 countries. It's a very large company. We can see that this one has a much higher PE ratio of 53.22% and a dividend yield of 2.21%. So it has slightly lower dividend yield, a much higher, almost over double the PE ratio. And we can see that for their 5-year growth. I think what did we check out here? We checked out the max growth. Let's go ahead and look at a 1-year growth. So their child company is 13%, and their 1 year is about 17%. Oh, there we go, 15%. So they have relatively the same growth during a 1-year period, and we'll continue on from there. So let's check out Abbott dividend.com. We can see that their yield is a little bit lower. They pay out $1.06 annually, and they pay quarterly, same as the AbbVie. They pay out a lower ratio, so they have a they pay out slightly less. So earnings per share, okay. They're the ones that have been paying out dividends for 44 years, and it wasn't so much AbbVie that had been paying out for 44 years, but they have been paying out since 2013, and as we saw on the charts here, that it has been increasing. So we can actually see a lot further history. We can see that during the crash, actually it's not the crash right there, the crash happened in 08. So I'm not sure what happened in 2013, but they did cut their dividend from 51 cents to 14 cents. So that was quite a cut there. So if we look at, let's see, where was that? 2012 in there. Let's see, 5 years, 2012. We can probably see a big, yeah, let's see, 2012. There is a bit of a, you can't really see it there, but there was a bit of a sell-off right there, probably because they cut their dividend. So this one has been paying consistent dividends since they cut it in 2013. So I don't like that they cut it, but that may have been, oh, you know what, 2013 is when the other company split off from them. So that's probably why they cut their dividend, because both companies kind of split off and they had to, yeah, that makes sense. Huh. Okay, so off to Colgate. We have Colgate. So the ticker symbol for Abbott was ABT. The ticker symbol for AbbVie was ABBV. Now we're looking at Colgate. Colgate is a very long-standing company, has been around for a very long time. It's been paying dividends for over 53 years. So taking a look at their quick chart here, we can see that their PE ratio is 26. So their price per earnings is slightly over our original look at ABVV. Their dividend yield is 2.18. So a little bit lower than ABVV and much lower than a little bit lower than ABT and much lower than ABBV. We can see that their 1 year growth potential, they've only grew 0.07% in 1 year. So this could be one that for its 5 year it does really well, but for a year right now that we're currently in where where we've had a lot of growth this year and this stock has not performed very well, that's kind of leading in the wrong direction. So let's go ahead and take a look at their dividends.com, and we'll see that they are paying out 54% right now, so a little bit more than our Abbott Laboratories and our Abbey. We can see that they pay $1.60 annually and it's paid quarterly. Again, they've been paying for 53 years. We can see that their ex-dividend date is July 14th. So that is next Friday, if you're watching this today on Thursday, so it's next Friday. And their payout date is August 15th. Let's see here, they've been doing, their annual growth for 2016 was 3.3%, and their annualized growth for the last 3 years has been 5.2%. That's pretty nice. So let's go ahead and increase the chart here. So Colgate, as you can see from their dividend payout history, they have never decreased. Ooh, there is a decrease back in that 98 crash, but beyond that, since then, even to 2008, they haven't decreased their dividend payout. So very good very good dividend history. They've been paying out regular dividends quarterly, and they pay out 40 cents a quarter for every share. Good information. Footlocker was another one that's ex-dividend date is next week. Now this one, I'm just going to go ahead and just show you that it is not on my pick. It was one of the ones that I had looked up because its ex-dividend was next week, but it's not on my list because its PE ratio is 10.25 after it's had a negative 10% drop off in the last year. It still has a high price per earnings ratio. Its dividend yield is 2.48%, which is less than it's greater than Abbott, but less than Abbey. If we take a look at their dividends, their information here, they do offer a very low payout ratio, only 24%. They've been paying growth dividends for 6 years since 2010, so they haven't been paying through a recession period. So I want something that is recession proof, and every other stock that we've looked at here has paid dividends for over 10 years at least. So it's been very recession proof. This one offers a 2.49% or a $1.24 paid out annually. If their ex-dividend date is July 12th, so that is next Wednesday. So again, this is next week's, and their payout date is actually this month. So July 28th is when you would get paid if you own this one on the 12th. So you could technically buy Footlocker for the ex-dividend date of the 12th, sell it on the 13th, and then purchase Colgate. But we're not going to do that. I want to just buy one stock. I'm going to lock in at the dividend right now because everything dropped today. So great time to buy. So let's go ahead and take a look at Footlocker's information here. Their dividend payout history. So they have been paying out dividends. Their information at the top says that dividend growth 6 years. So they had a stale time somewhere here in 2008. So they did continue to pay out dividends during the recession. They increased their dividends after the recession by 2 cents, but during the recession period they did not increase their dividends, but they continued to pay. So still good because they didn't decrease their dividends. If they had decreased their dividends, they would have probably had a much more investors would have sold off their stock and it may have tanked. But they kept paying their dividends through and through, and they've only been paying it's a 24% payout ratio, so very low. So they could increase their dividends dramatically here and kind of get back into the game. So we're not going to get into that much detail here. We are going to take out one more page here that kind of combines everything that we've looked at here. Now we're going to be taking a look at Abbey first, and I'm going to go ahead and take away the yield for right now, and we're going to say that over a 3-year period, we'll go ahead and make this 10 years. We can see that once Abbott became public in 2013, 2014 they had an increase in dividend in mid-year to 2015. They had another increase in dividend before 2015. 2015 hit, they had an increase in dividend, and then before 2016 hit, increase. So it's been a steady increase. Their dividend payout right there, or their dividend, we can see that their price is slightly over their dividend yield. That's just kind of, there's just been times throughout history we can see here that the dividend yield has outperformed the dividend price. Here the dividend price is below the dividend yield, so if you had bought in at when the dividend yield was above the price, you would have locked in at that higher yield per share cost. And one stock that this one's not one of them that where it's currently sitting at the dividend yield is over the price, but there is one of them here that is, as I'll go ahead and display here. So we can see that they don't have too much history. 2013 is when Abbott kind of broke off from Abbott. We can see that Abbott, though, we'll go ahead and do a 10-year. We can see in 2013 they did drop off a lot. So we'll see here that they had a very high payout ratio, dividend, but they decreased in 2013 when Abbott broke off from them. We can see that their price is also over their current dividend yield, and their dividend yield hasn't been very lackluster in the last couple of years. So not too great there. Colgate, if we take a look at their 10-year growth, we'll just say max. We'll take a look at max for Colgate because Colgate's a really good example of dividend growth here. There was a time back in probably 1980s, I think it was 84, oh yeah, we can see there's a crash right here. So right now I have chart options, US recessions. There was a crash in 98, and I think that's 92. Doesn't show me that exact year. Yeah, and 2008, that's actually a little bit after 2000, so May of 2000, I remember that one. And then 2008. But during that time, you can see that Colgate increased their dividends very big right after the recession. So during the recessions, there was still continuous growth right there, dividend growth, and then after the recession they would jump because they wanted to jumpstart their price. They wanted to keep their share price very without not moving. I'm going to show you here. We're going to go ahead and display it all here in a minute. And we can see that their dividend yield and their dividend price, the price is above their yield. Thought I actually had seen it opposite. It's Footlocker, that's the one. So Footlocker, nope, guess not, never mind. I'm not sure what I had looked at, probably looked at another stock. So we're going to go ahead and take a look at all of these stocks here by price, and we're going to go ahead and just do a 10-year. So you're going to see the recession period right here, and we'll see that in the 10-year period for all of these stocks. Now Abbott is not here. I'm going to go ahead and just take away the line there, and we'll see that during the recession in 08, when the recession hit, Footlocker actually did pretty good during the start of the recession period, and then had a very a long fallout period, and then took a while to recover back to its original almost point, probably almost three and a half years. Abbott Laboratories, during the recession, they stayed pretty strong. They did drop off a little bit, but within 2 years had recovered from their drop-off period. They did drop off a little bit again in 2013. You can see that drop off. That's because Abbott had split off from them, but they've had pretty continuous growth up until the recent years there. And then Colgate, during the recession, they also dropped quite a bit, but they had a much shorter recovery period. So they did drop off similar to the other ones in late 2008, 2009, but then it had a very fast recovery almost within the same year. It looks like 2009, and then just continue to grow and grow and grow. So Colgate is a nice looking stock, especially with the dividend. Let's go ahead and take these away. It's had a steady price and dividend growth throughout the last 10 years. So of these ones, Abbott and Colgate, I'm going to go ahead and take away the dividend and just look at the price. So they are both priced similarly, and we can see that Colgate is slightly over. We know that Colgate, looking at their PE ratio, they do have a pretty high PE ratio, so we'll get into that here. Okay, so I did start to write up my choice here, and I'm going to be writing up kind of my choice and why I chose it. I did create a chart here showing ABBV, ABT, Colgate, and Footlocker. So AbbVie, Abbott, Colgate, Footlocker are $100 we want to spend. So right now, if we bought one share of AbbVie, it'd be $71. We could buy 2 shares of Abbott because it's priced at $47.94. That would increase. That would make our current value, our current cost, at $95.88. So we still have $5 in our account, or about $4.20, 18. I can't do the math right now. 12 cents. And we can see that with 2 shares, we would get paid out quarterly, 53 cents. And Colgate, we would be able to purchase 1 share of Colgate for $73. We'd still have $30 in our account. Say $26.55. We would get paid 40 cents quarterly. And Footlocker, I'm just gonna include it because it was one of the ones that has its next dividend next month or next week, but it just wasn't enough growth in it, and history has been tumbling with it. It's been down in the dumps, so it's not really one I would consider. So of the 2 that I would really consider are Colgate and AbbVie, and of these 2, AbbVie is going to be my winner because they do offer a nice yield. Their payout history, even though they're not the parent company, have been paying out for 44 years. I believe that they are the stronger of the 2. AbbVie is much stronger than Abbott. You can see when Abbott and AbbVie split, AbbVie took a lot of the dividend yield, so it took a lot of the money with it, and has been able to pay out that dividend in the coming years. So I think it's very recession proof. I don't see AbbVie during the recession dropping their dividend in the future, and this is going to be a stock I'm going to be holding on long term. And even during recession, I believe it's going to recover very well within 1 to 2 years. And then during that recession period, I'm still going to be getting paid that dividend pay of 64 cents per share. So as I continue to grow my portfolio, this is going to be a stock that I'm going to continue to buy in the future and continue to grow in my portfolio. And that is it as far as our $100. So let's go ahead and make that purchase. So I do have my Robinhood portfolio here, and I'm going to go ahead and enter my PIN. Okay, and I'm going to go ahead and search for ABBV and look up our AbbVie, and we are down 1% today, so that's perfect because I'm going to be buying it at a discount. And it's too bad I can't buy fractional shares, otherwise I would. So I'm going to go ahead and just buy 1 share. Select OK. You are placing a good for day market order to buy 1 share of Abbott. Your order will be placed after the market opens and executed at the best available price. Swipe up the trade, and there we go. We can see that we have ordered our first stock order of $71.57. And markets are closed right now, but your market order has been placed and will be sent after the markets open. So that is it for this video. We have bought our first share. Those 4 stocks were primarily considered because their ex-dividend date are next week. I wanted to buy something that would get me a dividend pay, and that way I could show it off in an upcoming video and kind of show how dividend and ex-dividend works in the upcoming videos as well. And that is it for this video. I still have $24 of buying power, so stay tuned for the next video. I'll go ahead and possibly look for another stock within the $24 range, or we can make another video showing how to invest your $500. So that is it for this video. If you enjoyed the video, remember to like, comment, and subscribe. If you think I made the correct choice, leave it in the comments saying that you agreed with me. If you didn't like my choice and you may have chosen another stock such as Abbott, Colgate, or Footlocker, go ahead and leave that in the comments below. I will have my website updated with my information, and any of the websites, if you guys want to take a look at any of the websites, leave that in the comments if you're interested in any of that information. That is it for this video. Thanks for tuning in, and I will see you next time. Bye.